Hi everyone, today I'm talking about raising capital for businesses. Now, some of you are considering or probably in the middle of trying to raise capital funding for your business. And the reason why entrepreneurs and small business owners is raising capital is because they need the capital injection to help them grow faster. Of course, you can use your savings and your money, but the rate of growth will be slower just generally because you don't have that much investment in terms of dollars to invest in areas like marketing, acquisitions of new customers, expansion, globalization, hiring employees. They all need a capital outlay, which is why you will need support in capital funding from the people or investors or shareholders that believe in your idea. So in any case, there are many ways to raise capital funding, and capital funding can come from anything. So it could come from a bank, an angel individual investor. It can come from an investment group firm. It can also come by crowdfunding for ICOs now with cryptocurrency going around, as well as private equity money. So regardless how it comes from, capital funding is a common and a very popular exercise of many businesses, especially in the tech world, where scalability requires high injection of investment. So there are two ways that I would like to share with you today that is most common where businesses or growing businesses acquire capital. So one of the ways is investment loans, and the other way is generally equity financing. So they are loaned for investment. So some people take small considerable loans from individuals, friends or family network, and they use these loans to inject into their business to grow and scale. And in return, they guarantee the return of the investment over a period of time, say 1 year, 2 years, 3 years, 5 years, whatever that investors agree with the founder. And basically during this term, the investor is promised of an interest, which is most likely more interesting than the banks. But of course, it needs to be supported with the sales projection of the business itself. So if the business is expected to make generally a sum of money based on this capital injection, that's roughly the percentage that is going to be cut accordingly to the particular investor. So the founder would have worked out an interesting percentage that she or he can afford based on the returns to be given back to the particular investors as angel investment loan. So that is usually for small growing businesses as well as for businesses that generate revenue and gross profit. Now, for other bigger companies like tech and scalability companies, normally we trade equity in the form of investment capital. So which means we carry this person on board as our shareholder. So there is no need per se to return the capital investment, but convincing is tough to get investors or shareholders to come on board and buy a piece of our pie. So basically, whenever you instate a company as a private limited entity, you are made up of shares. Your company now belongs to you, but the moment you start selling parts and pieces of it, which means you sell the shares over, you sell it in exchange of capital funding. So if my company is worth $2 million, for example, and I sell it at, let's say, 10% of $200,000, then that's the money I raise, but that is also the percentage of equity I lose. So now my investor who's pumping the capital to support my vision, he now owns part of my company, and he will continue to own it over the many years to come until he exits, someone buys his shares, or the company gets fully buy out or exit at IPO where he cash out. So there's many ways why investors would want to invest in terms of equity, because the evaluation of a tech company especially, or any other company, it usually increases over the years based on the revenue, the number of users, scalability and penetration into global markets. So the company evaluation increases year after year, and so is the price tag of the company, which is what we call the evaluation. So as that happens, the price tag originally that the investor buy for 200,000, when the company share value increases 10 times the amount in the next 5 years, so is his share value. So people who invest in equity, angel investors as well, they normally do it because they see the profits and benefits in the long term, but they take a lot of risk with the entrepreneur because they need to make sure the entrepreneur are legit and as well are capable enough to run a scalable business based on the vision that they carry. So basically, I just wanted to summarize both of that, which is the common